Welcome back to Patrick Boyle on Finance. In today's video, we're going to talk about the new US Senate bill called the Holding Foreign Companies Accountable Act, which would force foreign companies to adhere to US securities law and what that means for investors. Okay, so the US Senate overwhelmingly approved new legislation on Wednesday, which could lead to Chinese companies like Alibaba Group and Baidu possibly being delisted from US stock exchanges amid increasingly tense relations between the world's two largest economies. The bill was approved by unanimous consent in the US Senate and would require companies to certify that they are not under the control of a foreign government. It would also require that foreign companies listed on US exchanges be audited by the Public Company Accounting Oversight Board. If a company can't show that it's not under government control, or if the Public Company Accounting Oversight Board isn't able to audit the company for 3 consecutive years, the company's securities would be removed from US exchanges. The Public Company Accounting Oversight Board, or PCAOB, is a little-known agency created by the Sarbanes-Oxley Act in 2002 to oversee the audits of public companies and other security issuers. The Sarbanes-Oxley Act required that auditors of US public companies be subject to external and independent oversight for the first time in history. Previously, the profession was self-regulated. This all came about in response to the Enron accounting scandal in, I think it was 2001, which brought down Arthur Andersen after it was found guilty of crimes in the firm's auditing of Enron. The Holding Foreign Companies Accountable Act is not yet law. For this to become law, it has to first be voted on by the House of Representatives, and then it would be sent to the President of the United States, who can choose whether or not to sign the bill. Once the President does sign the bill, it then becomes a law, so we're not quite there yet. So why is this an issue all of a sudden? Well, there have been a number of scandals in the last little while which have raised questions about the state of Chinese accounting practices and whether stock exchanges are doing enough to protect investors from fraud and accounting scandals. The most notable story of late has been the fall of Luckin Coffee, which has been all over the news recently, where they announced that they might have overstated sales by hundreds of millions of dollars. The Nasdaq exchange has since sent a note to Luckin Coffee that it intends to delist the company's ADR shares from the exchange. Around the world, the models of corporate governance differ according to the variety of capitalism in the countries in which companies are incorporated. The Anglo-American model emphasizes the interests of shareholders. The multi-stakeholder model associated with continental Europe and Japan also recognizes the interests of workers, managers, suppliers, customers, and the community. Now, corporate governance is of great importance economically. It's the whole reason that investors have faith in the capital markets and are willing to invest their savings in projects and businesses that provide jobs, economic growth, and products to the marketplace. I have a chapter, in fact, in my corporate finance textbook that I've linked to in the description below on the topic of corporate governance, which goes through the various laws and listing requirements, particularly in the United States. There's been a general trend towards better and better corporate governance around the world, and that's a trend that really started after the 1929 crash in the United States. In recent years, a lot of Silicon Valley companies have actually bucked that trend, and I comment on this in the book. Some of this relates to the growth of private equity and venture capital investing, where essentially companies no longer actually have to raise growth capital in public markets. It used to be that a company had an IPO because they needed capital in order to grow their company, and nowadays we're seeing that they raise an awful lot of their capital from venture capital firms or private equity firms, and in fact the public market is almost now viewed as an exit for company founders rather than the start of a business. But the fact that they no longer have to raise growth capital in public markets means that they might feel that they no longer need to adhere to market norms regarding shareholder rights. Today there are fewer IPOs than in the past, and exchanges have been competing to win the listing businesses of the companies that are going public. Facebook, for example, went public a few years ago with a multiple share class structure. This enabled founder shares to maintain 10 times the voting rights of common shareholders. The markets widely acknowledge that multiple share class structures are contrary to the best corporate governance practices, but Facebook at the time was considered to be such an exceptional asset that they got away with imposing an unfair structure upon its public shareholders. Now, shortly after that, Snap went public, issuing only non-voting shares to the public. Probably one of the worst examples, though, in recent years was Alibaba, China's largest e-commerce company. When a shareholder invests in Alibaba, they don't actually get an ownership stake in the company at all, which is what you might think you're getting when you invest in shares. Instead, they get an ownership stake in Alibaba, a Cayman Islands shell company that has a contractual arrangement to operate its Chinese counterpart. Now, the Chinese government has granted legal standing to that agreement, but it does reserve the right to change its mind, and if that happens, Alibaba shareholders are left owning nothing. Alibaba does not even allow its shareholders to vote for the board of directors. The board of directors is chosen by a group of partners, which is made up of the founder, Jack Ma, and his hand-picked partners. The Holding Foreign Companies Accountable Act can possibly be seen as a bit of a pushback by the US government after a few of these recent market scandals like the Luckin Coffee one, towards better corporate governance. It's possible to look at this legislation as being tied to the trade war between the United States and China, but it's worth noting that it's not just Chinese companies that would be affected by this legislation. Now, it's mostly Chinese companies, but it's not all Chinese companies. According to the SEC, the Securities Exchange Commission, 224 US listed companies are located in countries where there are obstacles to PCAOB inspections of the kind that this legislation would mandate. Around 158 of those companies are Chinese. The legislation is not specifically driven by Trump or the Republican Party, but rather is part of a bipartisan pushback against China in the Congress that has been building over trade and other issues over the last number of years. Last week, in fact, Donald Trump said on Fox Business that he's looking at Chinese companies that trade on US exchanges but don't follow US accounting rules. He said that cracking down could backfire and simply result in the firms moving to exchanges in London or Hong Kong. Now, this is an issue. Robin Li, who's the chief executive of Baidu, which is China's version of Google, he said that his company was not worried about the prospect of its shares not trading in New York. He said, the US government is constantly tightening its control of Chinese companies listed in the US. Internally, we are constantly discussing what we can do in response, including a secondary listing in Hong Kong or other places. Now, both Trump and Li are right. Companies can look around the world to find exchanges to list on, and in this environment with more and more companies never going public or being taken private in buyouts, exchanges are actually competing for listings. But no regulatory regime or exchange wants to be recognized as the place where companies with questionable corporate governance and accounting irregularities go to when raising capital. And so it's probably quite reasonable to expect similar regulations to appear around the world with the aim of protecting investors. Brad Sherman, a California Democrat, said that the legislation would protect US investors by ensuring that foreign-owned companies were subject to the same accounting scrutiny as US companies. Had this legislation already been signed into law, US investors in Luckin Coffee would likely have avoided billions of dollars in losses, he said in a statement. Some political analysts are saying that investors should expect swift passage of the bill, likely before the end of the month. From there, it will go to President Trump's desk, where he will sign it into law, likely within the next few weeks. Let me know your thoughts on this new legislation. I'm not very knowledgeable about politics or law, in all honesty, and so I'd love to hear what experts in my audience have to say on this topic. Don't forget also to hit the like and subscribe button if you'd like to see more videos like this going forward. Bye.